Anyway, speaking of spending and checks, the holiday shopping season may be coming to a close today, but investors will be waiting to unwrap which retailers will be on the naughty or nice list. Joining us now to discuss this is Steve Sadove. He's the former CEO and chairman of Saks. He's also a senior advisor currently for MasterCard. He knows a thing or two about consumers and spending. Steve, thank you very much for being here on this Christmas and Hanukkah Eve. So let's start off with this. Is the American consumer in a good position to keep propelling this economy?
I think so. It's clear that this holiday season they were out and shopping. The final numbers aren't in the till yet, but it looks like it was a very good season. The forecast had been for about a 3% increase in sales. I think we're going to be hovering at or above that kind of a number. The overall, the consumer was shopping in-store and online performing better than in-store. And overall attitudes, confidence, the consumer was shopping across categories, both experiences and stuff. And I think that as we go into 2025, they have jobs, the wages are increasing. Overall confidence is really pretty healthy. There's a sense of optimism. There are obviously clouds on the horizon, but I think going into the year, we have a relatively robust consumer.
There are ebbs and flows, and since the pandemic, we've seen this kind of flowing towards experiences and ebbing in things. But from what we're seeing across many different data points and surveys is that the stuff trade is back again. People are going back to buy things as opposed to just experiences. Is that stuff that you're seeing right now? Does your data, does your insight back into that kind of conclusion as well, that buying stuff is back in vogue?
Yeah, no question about it. I think what you had was a reversion to the mean. Think about it. Early in the pandemic, you couldn't go out. So there was no experiences. People were buying things for their home. They were stocking, they were buying groceries. And you had a certain categories were the winners. You had a lot of categories that were experience related, that were travel, getting out to sporting events, going out to eat. Those were losing. As you came out of the pandemic, you had a massive shift towards the experiences. And now what's happened is you're into a new cycle. You're getting renovations in electronics. You have a lot of innovation in other categories. So you're starting to see consumers back in to both goods as well as they're still going out. They want to go to restaurants. Restaurants continue to do well. Food has done well over the period of time. A lot of it is, some of it has been inflation related. You now have an easing off on the rate of inflation, but there's a demand both for goods and experiences as we sit right now.
As that pendulum swings back, Steve, how would you characterize the price elasticity? Because at least my online shopping, it seems like everything is discounted. Now, I don't know if it's discounted to the price that it actually should be, and it's just all psychological. But in terms of just the pricing power that retailers have right now, do you think they do have significant leverage in this environment?
Well, I think we're in an environment where value matters. If you look at who's winning and who's losing, the brands and retailers that are offering a value to the consumer have done extremely well. So while their consumer has a job, while they are getting their decent wage growth, overall, though certainly at the lower end, the consumer is very stretched, and value is an operative word. That's why I see the off-price retailers doing extremely well. All of the chains that offer high value are doing very well. So I think that this question of price discounting is clearly there because the consumer needs it. And you're seeing it in the winners versus the losers. So I think, though, that the level of discounting is controlled. If I were to compare the level of discounting this year to last year, I would say it's relatively in line. Inventories were in line. So as I would look at it, the margin expectations as we come through the fourth quarter are going to be relatively controlled and probably will be meeting the kind of expectations that analysts would have for margins. So I don't think discounting, while it is there and clearly evident, I don't think it's out of line and higher than you've seen, let's say, a year ago.